Hey, everyone, and thanks for joining us for our second session today of the 2025 Not-for-Profit Virtual Conference. I am still John Fadis, and I'm still one of the leading assurance partners out of the Chicago office. And pleased to introduce, well, first I need to give a little overview of the course today. What the speakers are going to be talking about today is staying ahead of evolving accounting standards is critical for compliance, donor trust, and accurate reporting. This session equips finance and accounting teams with practical strategies to strengthen audit readiness and align with the latest regulatory updates. So we have two great speakers today. We have Jeanette Schwartz, who many of you saw a couple days ago if you attended our sessions there. She's the leader of our partner on the advisory outsourcing side. And also today, Amelia Crawford, who many may have seen in some of our other nonprofit webinars and seminars over the years with Cherry Bekaert. She's an assurance director in our nonprofit industry practice. I will toss the baton over to the ladies, which I know are going to be a very enlightening presentation.
Thank you, John. And hello, everybody. John did the introduction, so I'm going to skip right over this and talk to you about our agenda. Our first two agenda items are going to be covered by Amelia from the audit side, our current environment and the impacts it's currently having, new and challenging accounting standards, past, present, and future. And then I'm going to jump in on what to plan ahead of time to have a successful audit, as well as challenges to a successful audit and options to consider. We're going to jump right into a polling question so we can see who's here with us today. Please tell us what type of nonprofit organization you represent. Association, charitable, either grant and contribution funded or various revenue streams, private foundation, or private school. Lots of charitable organizations. Great. Well, it looks like we have a whole lot of different organizations, so that's very helpful. Thanks everyone for completing that polling question. Amelia, over to you.
Sounds great. Well, I thought first it'd be great to kind of look at our current landscape when it comes to the not-for-profit industry. So we'll go through a few different areas of kind of the impacts to the current landscape. So first, looking at some gap considerations. For the first time in a very long time, I feel like there's no major upcoming ASUs that are specific to not-for-profit accounting. Knock on wood, I'm sure someone out there is listening and they'll put something out now, but nothing substantial affecting financial statements, which is great. I feel like we've had a lot in recent years. You can see here some recent standards. These are updates that have come out or updates to existing standards. So I'm going to go through each of these on some future slides and kind of talk through each of them. But you can see they may impact your nonprofit organizations, but luckily none of these things should really be too substantial when it comes to nonprofits, but still important to pay attention to and be ready for in case your organization could be impacted. Really a big impact right now to the industry is going to be related to government and federal funding and that single audit environment. So many of you, if you have federal funding, are probably aware that we do have a delay on our compliance supplement. This has caused some hiccups for some audit timelines. The supplement is basically the set of rules and instructions for completing a single audit. And each year, the federal government releases the updated version of that compliance supplement so that the auditors can audit any of the major programs as they would be required. With the delay this year, we haven't gotten that updated set of rules. And so that's really delayed any issuance of single audits for not-for-profit organizations and anyone else getting federal funding. But the big key here is waiting for that updated supplement to come out in order to finalize any of your single audits that may be done. So obviously having an impact on your financial statements. Also, when we look at the federal agencies, there's just been so many changes in those funding levels or uncertainty that's been created around future funding. We'll speak about that a little bit more on the next slide. We also have seen a lot of historical federal funding that's now starting to wind down, which is typical as, acts can change and funding can change. We'll see kind of that fluctuate over the years, but some of those key pieces in the last 5 years are now starting to wind down and no longer be applicable. Then on top of that, we do have some changes with those 2024 uniform guidance revisions that happened. And so we kind of saw a delay for implementation of those changes. That's because they started to apply to contracts that were for 10/1/24 or later. So you should have had kind of a continuation under those old levels while you were winding down those previous contracts. And now we're going to have some new transition and nuances that come into the future single audits that are going to be performed. A big one there is obviously going to be the increase of the threshold up to $1 million. So whereas before single audits, we were looking at that 750,000. Now we're going up to 1 million. And then also another, kind of big change that can impact organizations is that if you were using that de minimis indirect cost rate, previously that was looking at up to 10%. Now that threshold's been raised up to 15%. I will note for everybody, obviously, that's an up to number. So just make sure that you're aware of what your indirect cost rate is. That's something you want to make sure you're watching and calculating. Most organizations have a higher indirect cost rate than that, so it's usually not an issue, but important to pay attention to that because it is an up to threshold, not kind of a default 15%. And then obviously, with all the changes in the federal agencies and our current kind of status of the federal government, staffing resources at the federal level, and both federal agencies and maybe even yourselves and your audit firms, just having kind of the staffing shortages that just kind of the industry is seeing on a wide scale. Can obviously impact, if you have questions or you need clarity for timeliness of transactions, things like that. So big impacts right now, but hopefully everybody's able to kind of balance and work through them. So when we look at those federal grants and what the current, the implications of the current landscape would be, obviously there's been a lot of changes this year. We've seen agencies or grant programs completely abolished. Those waivers of COVID-19 spending deadlines, they are now being scrutinized and then in some cases being retracted. And also those federal agencies just, ending funding altogether based on programs that aren't aligning with agency goals. I think a lot of us saw those kinds of changes, especially with the DEI impacts. And that obviously affects nonprofit organizations closely because a lot of times, populations you may be serving are those that may align with DEI focused programs. And so we have seen obviously those court cases that are challenging those decisions. So a lot of what we've been watching is kind of changes being implemented, but then watching it play out through those court proceedings for whether or not they will be upheld or ultimately reversed. A lot of that, a big impact on organizations is just going to be, cash management in the meantime, if you have anything that's being challenged or if there's delay in payments. I know from some organizations that I've worked with, they've definitely seen a longer turnaround to getting reimbursements. Obviously with things like that, we encourage you to look at, more frequent submissions and things like that, rather than waiting for, a whole month to pass or something. You may want to shift your timing on that in order to help mitigate some of the time that it's taking to get reimbursements now. And then we've also seen an uptick in kind of those audits being done by the federal agencies, including any follow-ups on any findings that you may have had in previous audits. If you've ever had a finding, you may be aware that you write that corrective action plan of how you're going to correct that finding in order to mitigate it in the future. And so there's just been kind of an uptick in follow-up on those items. We'll see if that continues. Obviously with furloughed employees, you may see that kind of decrease, but it doesn't mean that that may not then come back around once they're back at a more regular capacity. So definitely something to be paying attention to. These are all things that can have a big impact on an organization. And any time where you're running into issues with reporting or findings, those things affect, whether or not you're considered high risk, and that gets disclosed as part of your single audit. So important to try and, work through any of those findings and make sure that those aren't repeated in the future if you can help it, so that you can have, your best foot forward, the best picture when you have that single audit. So when we look at the implications, obviously, as I mentioned, that can increase your risk. So basically looking at your cash flow, whether or not you need to be, finding funds from other sources or relying on other funds, or if you're just, now facing financial pressures just because of the timing of those funds. It also could change what programs you're participating in. So you could be changing how you're getting your funding for your organization. And depending on what program you're being funded through for your federal funding, that could change, what types of controls you need to have, what types of rules you need to be following to be in compliance with that grant or to be in compliance with the supplement. So really important to be paying attention to each of your programs, your requirements, any changes coming from those supplements. All of those things kind of carry through and affect the organization when it comes to your annual audit, and especially if you have a single audit. And then obviously you want to be sure that your auditors and yourselves are staying informed of those changes and they're able to adapt to the changes. So you want to be able to have a good understanding of what is changing, how that's going to be audited, what kind of trail that you can provide, what support you can provide, so that that can get audited appropriately and doesn't cause any kind of problems when it comes to your audit itself. So I'll shift in now to some new and updated ASUs. As I mentioned earlier, nothing too major on the horizon, but it is important to understand each of these changes so that you're aware whether or not your organization could potentially be impacted by these. And just for those that may not always be familiar with the acronyms, I know accounting loves their acronyms, and ASU is an accounting standard update. So it's essentially updates to GAAP that are happening throughout each year. So the first kind of big update that we're looking at relates to leases. So this is one that was a new standard in the last few years. It was put out a while ago, but came out recently finally to be implemented. It had been kicked, down the road a bit with COVID. And then as it got implemented, there arose a lot of questions. And what that basically resulted in was a lot of items going into the FASB about where they needed clarification within that new standard in order to implement it properly. So what you're seeing with this standard update, which is ASU 2023-01, is some updates related to leases when they're considered to be under common control. So that's when the lessor and the lessee are considered to be under common control. There were, a lot of times where those types of leases may not have a lot of written leases. There may be, verbal agreements for what payments may be. It may be, written for a shorter amount of time, but assumed that it'll last a longer amount of time. So it created a lot of complexity when implementing the lease standard, just because you weren't quite sure how you should be calculating it. Is it based on what's written? Is it based on verbal agreements? Things like that. And then especially, when it came to leasehold improvements, normally you would match leasehold improvement useful lives to be to your lease life. But in cases with common control, you could reasonably estimate that those leasehold improvements are going to match the overall life of the asset instead of just a written lease. So this standard update really was targeted at bringing a lot of clarification to those common control leases so that it would be clear for everybody implementing how you should be considering them. So it looks at the terms and conditions for the leases, and what it wants you to rely on is the written terms and conditions. So whatever is documented and on paper, that's what should be considered the terms and conditions when implementing the lease standard. There's also some changes for the accounting for leasehold improvements. I'll cover that on the next slide. For this standard, we're looking at it being effective for fiscal years that begin after December 15th, 2023. However, if this is something that's applicable to you and you want to implement that sooner, you have an early adoption option with this standard. So when we look at leasehold improvements, when they're related to common control arrangements, we do want to amortize those assets over the useful life, so long as that lessee is controlling that underlying asset through a lease. And that's accounted for as a transfer between those entities with an adjustment to net assets if that lessee is no longer controlling the asset. So if there comes a time where, you know, the useful life has not been met of that asset, but they are no longer controlling it, then that's going to be an adjustment between those entities that happens through net assets. And then obviously with any kind of asset like that, you are going to be subject to impairment considerations. So ensuring that that value that's being reported doesn't exceed the true value of the asset. So we're going to move into polling question number 2. What is the most challenging part of accounting for the lease standard 842? We've got A, explaining it to leadership and to the board. B, the right of use asset and liability calculations. C, everything. I've outsourced these calculations and disclosures and the updates. D, understanding what value this brings in accounting for leases this way. And then E, all of the above. So we'll give everybody a minute or so to be able to respond. I know personally, I know Jeanette, how you are. I know for me, it's kind of all of the above. Not my favorite standard.
The clients that we work with, it is definitely not their favorite standard, and it is my least favorite thing to try to explain, and the why it was implemented in the first place.
Yeah. It'll be interesting to see everybody's response here. All of the above. Yeah, I'm not surprised that that's the majority win. This standard, I mean, it definitely was one that it's kind of, you know, the actions of a few are affecting the masses. You know, there was a lot of people that took advantage of the bright lines of the old GAAP to write leases that were just below all the thresholds. And so that really drove the need for this standard change. But unfortunately for the masses, it may not feel like too much value. But luckily, if this is not something you enjoy calculating, there are a lot of ways to get help with this. I know Cherry Bekaert helps. There's you know, software that can be used to calculate it. So hopefully not too much of a burden anymore on organizations as it continues. So where could things go wrong with the lease standard? Obviously, the big things is it's going to be the calculation of your right of use assets and your right of use obligations. Those are all dependent on lease terms and all the various considerations that go into the inputs of a lease. And so obviously, if you aren't accounting for that correctly, especially with those common control leases, you could get an incorrect calculation of your right of use asset and obligation. And then obviously, when it comes to your leasehold improvements, this standard is going to affect the useful life, which will affect your depreciation as you know, kind of depreciate the asset over its useful life. So you want to make sure that you're following the standard changes and getting those things calculated correctly. All right, so our next standard is related to the credit loss standard. So another standard that was implemented in recent years very similar to the lease standard. There were a lot of questions and clarity needed around the implementation of the standard. And so what this ASU is doing is kind of giving two different updates to help with the implementation of that standard. So this is ASU 2025-05. The first part of the standard is putting in a practical expedient that can be elected. And that's going to be related to developing your reasonable and supportable forecasts when it comes to calculating the credit loss allowance that you would need. So as a quick reminder to everybody, what CECL really changed was you took into consideration your historical loss rate, but then you needed to adjust that historical loss rate for any current conditions, and then also for any future conditions based on any reasonable and supportable forecasts that you may have. That obviously is not going to be the easiest task for everybody, especially if there was a lot of uncertainty of what would be, a reasonable estimate for those forecasts for the future. What this practical expedient allows is essentially for you to assume that the current conditions that you have would be representative of a future impact. So you do need to elect the practical expedient. This would be something that you would want to include within your discussion in your footnotes about how you're calculating that, if you're making this assumption that the future state is essentially going to be the equivalent of the current state that you're in. The second consideration here that you'll see is the accounting policy election. So that's an election that is looking at any collection activity that is happening after your statement of financial position date or the financial statement date when you're estimating what your expected credit losses will be. So to put it kind of simply, essentially, if your year end is June 30th, for example, and say your audit is going to be happening in September of that year, you could use the activity that happens between June and September to help estimate what a true loss rate would be for those receivables that you have at year end. And so it just lets you look at kind of that activity that's happening just after year end to help formulate that true loss rate that you're expecting for the year end amounts. And this can be especially helpful when you have short-term receivables, things that you typically collect in maybe 45 to 60 days, where you may not incur a lot of losses and you feel like you don't have a high loss rate expected. This election can let you kind of look at those collections and then come back and say, have a good support for why you think that allowance is the reasonable amount based on what you've been collecting after year end. Similar with the practical expedient, you do want to make sure that you have these things properly disclosed with your footnotes. So always something to pay attention to in your accounting policies, just to make sure it's clear if you're adopting any of these elections. You certainly don't have to adopt them. They're just available to kind of simplify any kind of implementation of the standard and gap under this new guidance. So just a quick reminder, because it does have an impact with nonprofit organizations, there are certain items that are not in scope of this credit loss standard. So when we have contributions receivables, or essentially receivables that are associated with non-exchange, so contribution, donations, pledges, any of those words you like to use, those are things that are not under the CECL standard. So those are all going to follow the past methodology. You still need to consider whether or not you need to have an allowance recorded against them. But the difference is that change in the standard, where we look at current changes and future changes, that doesn't have to be done in the same way for contribution receivables because they were scoped out of the standard. Similarly, if your grants are related to contribution activity, meaning they're not exchange transactions, you're not providing a commensurate value back to the grantor, then those are going to be similar to contribution receivables and not be in scope of CECL. And then also, if you have loans or debt that are already measured at fair value, you don't need to have the consideration of credit losses. Because essentially they should already be at what their fair value would be considered to be, and you wouldn't need that additional loss allowance in order to present them appropriately under GAAP. So that one may be a little bit less common for organizations, but still important to note that you would scope those out of this standard as well, just like you would the initial credit loss standard. So where could things go wrong? Obviously, the calculation of your credit loss provision is affected by your consideration of the future conditions. And so if you do elect the policy election that allows you to, the practical expedient that lets you look at, say future is the same as your current state, or if you make the election considering any collections after year end, both of those things are going to affect the calculation of your credit loss provision, and so could impact what is ultimately recorded on your books at year end. So just be sure that if you are making those elections, you reflect that in your calculations so that you're aligning your approach with what you're selecting and disclosing in your financial statements. All right. Our next one is going to be related to crypto assets. This is a big change that's coming through as far as the presentation of crypto assets. It's going to affect both the scope and measurement. You can see here, this is ASU 2023-08. So it was put out a couple years ago, and then now it's becoming effective for organizations. So it's effective for fiscal years beginning after December 15th, 2024. And it's going to kind of change a few things across the board for crypto assets and how they're being presented and disclosed within the financial statements. The big thing here to keep in mind, this is when crypto assets are actually being held by a not-for-profit organization. So there's a lot of times where an organization may accept crypto assets, but immediately convert it to cash. That is not really what's being changed with this standard. This standard's really focused around those that are actually holding those assets and reporting them as part of their statement of financial position. So the standard changes are going to provide guidance for how you're going to measure, present, and disclose those assets. The measurement is going to be moving to fair value, and you're going to have the changes in that fair value be recognized through your change in net assets. So it's not going to be a below the line, it's going to go through your change in net assets. And then in the year of application, you're going to adjust your beginning of net assets for the transition over to fair value. So I thought it'd be helpful to kind of look at it as to which statements are affected in which ways. So when we look at your statement of financial position, you're now going to have that intangible asset that's measured at fair value. And you do need to present those separately from other intangible assets. And that's because your other intangible assets are not using that same measurement base. So it's the same when you have any kind of investment, that may be at fair value versus a contract value. You want to show them distinguished, on your statement separately because they are not following the same measurement. You're going to have different disclosures connected to them. So they need to be independent of each other when you're looking at the statements. On your statement of activities, you are going to have those gains and losses for the change in the fair value that are going to be presented as your part of your net asset change. And those also need to be separate from any amortization or other impairment of intangible assets. You want to basically make sure that they get their own distinct lines so that it's very clear as to what that change is truly relating to. So an amortization, of a capitalized, intangible asset isn't going to be the same as a gain and loss for the change in a fair value of an asset. So you want to keep those things distinct from each other. And then in your statement of cash flows. So this one can be a little bit of tricky wording if you don't love a cash flow statement, which who really loves a cash flow statement, right? But any crypto assets that are received and held in the ordinary course of your business or those that are converted nearly immediately to cash, that's going to fall within your operating section of your statement of cash flows. What will be different is when you are holding those crypto assets or those that are liquidated nearly immediately, but they're for donor restrictions that have long-term use or capital use. So things you expect to capitalize if you're going to be purchasing a building or some other kind of long-term asset. That's where you need to look at that financing activity. So a good way to kind of have it in your mind to think about if you're using that cash or that asset and it's related to just ongoing operations, that's going to sit in that operating activities. But if it's really funding something or it's donor restricted related to something that's really long-term use or capital use, you're really using those funds as a financing option. And so it needs to be in that financing section of the activities. So a little bit of distinction there that would need to be followed. And then where could things go wrong? Obviously, you could have an incorrect presentation of your crypto assets. This is a big change. Before it was really just an intangible asset. It wasn't at fair value. It wasn't presented the same in the statement of activities. So this is kind of overhauling how they're accounting for those crypto assets. So you want to be sure that you get it implemented correctly if you do have those kinds of assets held at the organization. And then obviously, anytime you have something presented at fair value, you do have additional disclosures that go into your footnote. So it's important that you're tracking the right information for those disclosures. Always something that your auditors that we could help you with. But if you're not certain, just taking a look at those required disclosures and making sure that you've got that information in order to provide for your financial statement prep if your auditors do that for you. Or if you're doing it yourself, then you need to remember that these are just like any other asset that are at fair value and have those same disclosures required. Our next ASU is ASU 2023-09, and this is looking at improvements to tax disclosures. So may not affect a lot of nonprofit organizations. However, if you do have the unrelated business income tax, so UBIT, or if you have a for-profit subsidiary, this standard could still be applicable to your organization, and it's worth understanding. Basically, the standard is look at providing a lot of transparency of the tax information that would be in your disclosures. So you can see here on the screen, it's got more transparency around your rate reconciliation, your income taxes paid, and then other disclosures that may be required. And what that basically means, the rate reconciliation is looking at what are the standard rates for that type of entity or for that type of activity that is creating tax, and then comparing that to what your effective tax rate would be based on the amounts recorded. The income taxes paid is looking at your cash that you have paid for income taxes. So that is something that has to be disclosed as part of your statement of cash flow, as well as they want to know that cash activity for taxes paid. And then for the other disclosures, the big key here is they really want distinguishing lines between not only domestic and foreign, so US and international taxes, but also looking at distinction between your state and federal disclosures and ensuring that those amounts are separated between the different categories that they were created from. So definitely expanding that footnote if you haven't been disclosing this information already, and does have an impact on your footnotes. So this one is going to be effective for fiscal years that begin after December 15th, 2025. So that's going to be moving into next year. However, you do have the option to early adopt. So you could already be implementing it for this year. And then it is going to be applied on a prospective basis. However, you can do a retrospective application if you so choose. You would just have to disclose which approach you're taking once you do implement the ASU. As for where things could go wrong with this standard, obviously you could have some incorrect presentation in your financial statements, or you could end up with some incomplete disclosures if you're not capturing all that new required information, or if you hadn't already been disclosing that information. And then we've got to take a look at some internal use software. So this is a big change that's coming as well. This is ASU 2025-06, so just recently issued. This one really changes kind of all the gap that we used to have for internal use software. So if this is applicable to your organization, you may be familiar that in the past, it was very much based on what project stage you were in for whether or not you were expensing or capitalizing any kind of costs that you may have in connection with development of the software. What it's changing to is really a threshold approach. So the past was really stage approaches, and depending on what stage decided on which method you should be following, expense versus capitalization. Now what's changed is that threshold. So it's really just expensing, and then once you hit your threshold to capitalize, then you'll be capitalizing your expenses after that. So capitalization under the new standard is going to commence when both of the following bullets have occurred. One is that management has authorized the project and they're committing funding to the project. So essentially, you're looking at that to be similar to, your viability consideration before. Is this really a focus of the organization? Then you're going to be looking at whether it's probable that the project will be completed and the software is going to be used for its intended function. So that's now called the probable to complete threshold. So essentially you want it to be funded and authorized, and you want it to hit that probable to complete threshold. At that point, you're going to start capitalizing any of those costs as part of what's going to be your software that comes onto your balance sheet. So much more simple than the past approach with the stages. The stages were always a complicated thing. I remember many years sitting down with organizations and having to kind of map out where projects were, meet with many teams to ensure that we're in the right bucket. This really is going to simplify it, make it easy to follow and know when you need to just be capitalizing it. And then obviously with any capitalized asset, you're going to be amortizing that over its useful life. This is going to be effective for fiscal years that begin after December 15th, 2027. So it has some time before it would be required to be implemented. However, early adoption is permitted. So if you're kind of in that in between, you guys are looking at doing some internal use software, you may want to look at early adopting this standard just to have that simplified approach. Or if you feel like you're going to cross into when this would be required, you may want to early adopt so that you're not having to follow two different types of gaps over the course of that project. So important to keep this on your radar, especially if this is something that your organization could be looking at doing. So where could things go wrong? Obviously, this is a complete change to gap before. And with the elimination of those project stages, it's going to change how you're going to be accounting for kind of the project status and what you need to be tracking. So rather than tracking those stages, you're really going to be tracking whether or not it's been funded and approved, and then if it's hit that probable to complete threshold. So you need to be tracking whatever required data you're going to need to in order to substantiate that you've met that threshold for capitalization. That'll be something you will want to be able to show to your auditors, for example, when you get to that point of capitalizing. And then obviously you need to be tracking your costs so that you know when that threshold is met for when you need to start capitalizing them instead of expensing them into the income statement. All right, so I think we're ready for polling question 3. What are the most challenging technical accounting areas to understand and implement? The first response, A, revenue recognition. Could this be more complicated? True. B, internal use software, whether you capitalize it or not. C, footnote disclosures in the audit. I only do these one time a year and no one understands or reads them anyway. D, accounting on the accrual basis, or E, other. It makes me sad when people think that about footnote disclosures, Jeanette, just because I spend so much of my life in financial statements.
I remember those days, but left audit a long time ago.
Yeah, I will say boards definitely love the summary more than reading the footnote themselves, I'm sure. So cannot blame them there.
A couple questions, Amelia, while we're
Yeah.
waiting. The first is on crypto assets. In our client base, how much are you really seeing our nonprofits holding those types
Yeah.
of assets? And we've got the results up, but let's take these couple questions.
Yeah, and it looks like the results are kind of what I expect anyways, kind of spread across all of them, with kind of revenue recognition and footnotes being the key ones there. As far as the crypto assets, truthfully, I don't see a lot of organizations holding them. I remember a few years ago, it really started coming up a lot as questions about, can I accept crypto? And really what we saw the most of was organizations immediately converting it to cash. In cases like that, it really doesn't add a lot of complexity to the organization. Usually you can use some kind of third-party provider to convert it. You're not actually holding it. You avoid that risk. So there's so many risks associated with holding crypto and doing that appropriately so that it's secured, that I see most organizations really just convert it immediately to cash. I don't see a lot that are holding it. So definitely, I don't feel like that one's going to be a huge one, but if you are holding it, it obviously is going to be a big impact if you have that as an asset.
Great, thanks. Helpful. The other is on internal use software.
Yeah.
The threshold above which you start to capitalize, should that be based on the organization's organization capitalized amount?
So that needs to be focused around, and let me switch back to that slide just so you can kind of see the exact language. That needs to be focused around what the standards outline. So it needs to be less kind of a threshold for the organization and more around the software itself and its development. So it's when it's probable that the project is going to be completed and you're going to use the software. So you're going to want to leverage whatever team you're using to develop it. It may not be an accounting and finance team decision where, if you think about fixed assets and things like that, it's really, a dollar amount. When you're above this amount and you're creating an asset, you're going to capitalize it. This is really more going to be focused around the software itself. Is it likely it's going to be completed? Are you going to be using it for what it's intended to be used for? So this is where you want to leverage whatever team is really developing that and get a good idea of whether or not it seems it's probable that you're going to be able to get out of it what you're planning. So it definitely is not something that's going to align with some kind of capitalization threshold that you may have done in the past. It's really going to be specific to the software, and are you going to be able to complete it and use it for what you're hoping to?
Okay.
And with that, I'm going to hand it over to you, Jeanette, to look at preparing for an audit.
Okay, well, Amelia has given us a lot to think about, all of which she expects to be done completely before she comes in and tries to audit what you're doing. So this is where I come into play. While I used to be in the audit world for many years, we help lots of clients do audit preparedness, as do other firms. And it may cost you time, stress, money, all kinds of things, paying the auditor a lot more if you're not ready on day one. And I think this is one of the biggest things that we see is that there is no guarantee that the auditor is going to finish by your agreed upon deadline, which your board is relying on typically, if you're not ready. And you may want to review your audit engagement letter because these days it says that you need to give us X or we cannot agree to necessarily meet your deadline. So that's very, very important. If you are not ready and within the 1 or 2 weeks or 3 weeks that your auditor is, I would say, in the field, although in the field tends to be remote these days more often, if you are getting out of that time frame that you have both agreed and the auditor has committed to, that doesn't mean when you are ready to give them whatever they need to finish the audit, you're going to get the same audit staff, which means, and this is a common complaint, can be that you're going to get repetitive questions from your auditors. Well, geez, so-and-so asked me this 3 times already. So it's a learning curve. No matter how well that audit staff is engaged, documented, and planning, it is likely going to increase the time incurred. And I will also say that if the more time it takes to, that the auditors have to take outside of what was agreed upon on expectations to finish the audit, they're going to want to charge you likely for those hours if it was not the fault of the audit firm. And no offense, Amelia, nobody likes to pay for audit costs. So be careful, and also your audit engagement letter also probably notes that any audit fee is quoted for you doing X. And when we say clean and timely audit here, that's I would think, inherently expected. You get this X, will produce Y. When you don't finish the audit in the time frame agreed upon, your accounting and finance staff have to go on and try to do their own job, so it's stressful to them. Your auditors, it's certainly stressful on them when they have to jump back in and out over the course of a few months trying to wrap up the audit. And your internal staff are trying to keep the trains running while the auditors are firing away things they need as they go through their process. So while you may have to stop what you're doing to appropriately plan for an audit, it is way out going to weigh the costs later on down the line of having your audit drag on for months and months, and sometimes even longer than that. And the last bullet is, we're working with nonprofits. Senior leadership has made promises to the finance and the audit committee and the board of directors, and financials are supposed to be presented at a particular time. And while they are, you don't want to have to tell them the why this didn't work, especially if it's an internal reason, and you can't, point the finger at the audit firm. It just is better to set aside time up front. All right, continuing on, trickle down effect. Hopefully you can see what I'm going through here. Reporting deadlines that are affected outside of the audit, finance, and the board meetings. The longer an audit goes, the more compliance deadlines you may be in jeopardy of missing. The 990 deadline, you have multiple extensions that you can do before you have to file the 990, but you really need to finish your audit and have final numbers before you do audit preparation. And ultimately, there is going to be a final deadline. So plan accordingly. You can file, if you're not going to finish your audit for whatever reason, things happen, you can and should file the 990. However, you are at risk that when the audit is finalized, you are going to have to redo the 990 or update the 990, amend the 990, which is going to result in additional costs. Those of you who have a single audit have a 9-month after year-end deadline to submit it. As a reminder, the financial statement audit and the single audit are all intertwined, have to happen at the same time, have to be done. And then the data collection form has to be filed after that, and all within the first 9 months of the year end of the organization. The next one here is charitable registration deadlines. Lots of you on the charitable side that are getting contributions from various states have state deadlines, and many of those state filing deadlines are going to require an audit and or the 990 as an attachment. So keep that in mind. Budget revisions. So this goes to more, which I'm gonna kind of go through later. It is really important that you kind of keep a mindset that as if you're going to go through an audit, in my opinion, every single month of the year, because you want your audit not to be a heavy lift, which kind of goes to what I'm saying in being prepared. You present a budget. The budget should be on an accrual basis. If you keep your financials on an accrual basis, then you're not making a ton of adjustments at the end to prepare for the audit. And if this is the case, frankly, and you are say, let's keeping modified cash basis or cash basis during the year, you need to get a clean unmodified opinion. So you got to convert to accrual basis. That's going to, in most organizations, take a lot of time. And I would argue that your audit committee, your finance committee, your board are going to look at what you presented internally during the year and compare that to bottom lines and things in the audit. And they really should align. What does it mean to be audit ready? Planning versus field work. Almost all audit firms are going to have two different types of time segregated. One is for planning. Auditors were going to want a preliminary trial balance. They're going to want to see what things look like so they can plan their procedures. Audit procedures are not the same every year. You can hear from Amelia, things change, but it is also a risk-based approach. So they're going to need to see what's happened during the year in terms of looking at some financial information. So you need to be prepared and relatively up to date. It doesn't need to be final year end numbers, but something close to the year end. And then if there is a single audit, the planning part is even more important because they are going to want to pick their the federal awards that they're going to test. They're going to want to tell you the federal awards they want to test, and frankly can get started ahead of time because they're going to give you a sample that they're going to need support for. All of that is part of the planning process. And then there will be another, what is called PBC list, prepared by client schedule that they're going to need for the end of the year. So it's a lot of work, as I said before. If you are kind of in the mode of being audit ready relatively during the year, this will not be a terrible, awful thing that you have to go through. The second bullet here, which does also happen a lot, is being ready on day one of the audit. Means having everything uploaded to the audit portal. Most auditors are using an audit portal. They give you the list, hopefully well in advance of when they're going to need it. You need to get everything updated. If you say, well, I got 50% of it uploaded, they can get started. True. But then immediately when they start looking at things, they're going to flood you with questions, additional requests, and you're going to be trying to finish up things. Finishing up things means potential adjustments. It also could mean tracking down information from your program folks. You need to be 100% ready from that PBC list to the extent that you can so that you are available for pulling information and questions during the audit, which there are going to be a lot. And some of them are variance explanations. Why did this happen? Why didn't that happen? So it's not just about pulling invoices and whatnot. Hopefully you have good technology, and sometimes you can give the auditors read-only access to things like your disbursement software platform so that it's saving you some time. Fully accrual basis, again, kind of mentioned this. You're not required to keep accrual basis during the year, and many organizations will say, well, my board, everybody doesn't really understand this whole accrual thing. I understand, but there's a reason for it, and even a modified accrual basis provides a better reporting during the year of what's happening as opposed to cash basis. And then you're not building in a lot of time for converting at the end of the year. Field work, I would say, for our mid-size organizations lasts anywhere between 1 to 4 weeks. If you can't be available to the auditors timely, it's hard to get it done. It should always be the goal to focus on them when they're there. Tell the others in the organization who are constantly knocking on your door and sending you emails of all of their needs that you just need to, as much as possible, block this time, and why. So that you can get the audit behind you. That includes financial statement preparation, schedule, functional expenses, which sometimes falls to the end. And you can really put the lid on this in the time frame that everybody really wanted it to be done in the first place.
These are all really great. If we could just educate everybody on this, right? Like I can't stress enough, even the planning pieces. getting us that kind of stuff ahead of time, you're absolutely right that it can make such a difference, because you can get so much stuff knocked out that doesn't have to be time sensitive and wait for year end when you focus it that way, that it really can change your audit timeline. So I mean, you're absolutely right. Like when you're staying up to date with it throughout the year, you get that ability to kind of pull some of that stuff out of the year end, and then it's not time sensitive. So all really great suggestion. I can attest as an auditor, I would love if everybody followed all of this.
And I would say not just for those who are not auditors on this webinar, for those auditors that are listening, it is super important to communicate some of this. Your folks that you're auditing are different levels. They might not have been through an audit. They may just really have been in their own company and not really outside of different organizations. Spend the time planning meetings up front, insist on them, and explain these things. Explaining them in the middle of it is not as good.
Yeah, it doesn't work as well when you're trying to do it on the back end, but yeah, all of these things are really, really important pieces, and can really make or break how the audit goes. It does not have to be a painful thing to have an audit done of the organization. And it's probably a little bit painful. I like to pretend it's never painful.
Well, you do a great job, Amelia. Okay. Okay. Challenges to being prepared. There are going to be challenges. This first one is number one, turnover in staffing. You have all the people that have the historical knowledge and somebody leaves. Now you've added workload, or you've hired somebody new, or maybe you decided to outsource, and those that are in charge of working with the auditors and preparing for it are new, don't have all the history. We're going to talk about what to do. I think I mentioned our firm does a lot of audit preparedness, as do some others. If you don't have enough hands, ask for help. The audit, well, I said, is not always the same every year. You shouldn't plan for it to be the same. A lot of it really can be. So bringing in firms or help that are used to and understand what the auditor needs will just save you time and aggravation. You have staff in place that just are underperforming your performance issues. I would say try to get on top of those, and again, bring in help or figure out how you can shift some things around. I talked about the next one. Time to train replacement staff takes away from audit preparation. So you have somebody new in there, the auditors are in there. You're trying to get everybody up to speed. These things are going to happen, and I would say, just own it. Communicate with the auditors during planning. Here's what we're dealing with. We've had turnover. Okay, so then the question might be, we need to delay the audit. It's worse to get in there and try to do the audit, which probably is going to result in findings and things of that nature. Better to get it all together and push the audit out and communicate that with your board if you've had unexpected things happen during the year. Outdated accounting systems, those of you who heard me on the Tuesday, systems is hugely important. There is so much automation out there to save accounting costs in terms of salary dollars by just implementing some good systems and processes. If you are, finding things because your structure isn't good enough to kind of find documents easily, and you're searching around your drives, or you're still pulling paper, or things aren't saved right, that is takes a lot of time. Accounting systems these days, documentation can be saved right inside where the journal entries in the system, and there's just a lot you can do to really help facilitate this to be an easier process. Other things come up, which I've said, you got and that's going to happen. That's just what it is. No one stops the organization to do the audit. But you, just like anything, like fitting in a new system or fitting in the government shutdown, you have to take the time to stop and meet and figure out what are we going to do about this. Board priorities. There's a lot of pressure from the board to do lots of things and to get these reports. And now our eyes off the ball on the audit. I always go back to communication. Anybody on my team knows that is my big buzzword. Communication can fix a lot. And then, as I said, converting to accrual base for the audit takes a lot of time. Again, I've talked a little bit about, or a lot about some of these, underestimating the time to prepare. I will say on this, well, I got a week, I'm going to get ready for the audit. Remember, this is an audit of really two things. One is your assets, liabilities, and your net assets at one day of the year. So that may not be such a, a crazy thing, except if you haven't been doing monthly closes consistently and reconciliations, and you're trying to do that for the entire year, very tough. And the second thing is your statement of activities. It's for 12 months of activities. There's just more than pulling documents. You've got to think about, does this look right? What questions are they going to ask? Do I have the answers to them? So plan ahead. And as Amelia said, do as much as you can way ahead in advance, not just when you get the PBC list, because much of it is going to be similar to the prior year. Amelia, hopefully everybody just listened to the first 25 pages or so, or slides of her presentation. This is also something we see. No one wants to focus on lease standard 842. It doesn't mean a whole lot to most organizations during the year, so I'll just put it as part of the audit. Don't do that, or plan enough time in advance to handle it, or say, I'm not going to have enough time, which is also planning. Let me find somebody to help here and implement this, or what I also suggest is getting folks to think about how they're going to approach it, find a resource, and often your auditors present them. Here's what this is going to look like. We need you to concur or not concur, make sure we're on the right track. Don't wait to get their buy-in if it's something complex until you're out there in the middle of the audit. They cannot tell you how to necessarily implement, but they can educate and consult. I think I said all the rest of these, so I'm just going to get off my soapbox for this slide. All right. I'm expecting some good results here. When do you start to prepare for an audit? Is it a week before? Is it a day before? Is it, I'm not going to advance preparation anything. We'll start at the same time the audit begins. Does it depend on the complexity, or at least a month prior? What do you guys think?
I'd be curious on these. It's kind of like when I hear new staff talk about how long they study for the CPA exam, right?
Right. We're going to get out of it.
Indicator, right?
Yeah, you get out of it what you put into it.
Absolutely. Absolutely. I love the one comment, prepare all year. That just brings happiness. Hopefully it's not too many C's. That will be a curious one.
All right.
All right, 2% C. Wow, bold. You guys must have good accounting systems.
Well, listen, if you're doing lots of great things during the year, it's possible there's very little advanced preparation. And good on
That
you.
is a very good point. Yes, the audit shouldn't ask anything that you don't already track or know. So,
Right.
yeah. Yeah.
And preparedness during the year too. When you know the auditors, oh, they're going to need this. I got a new CEO contract, or then you have an audit folder, throw it in there. Oh, we had a legal issue. They're going to ask me for the invoices. Throw it in there.
Yeah. And I know, even some of our request list will, you have audit standards that require us to clear them out. We can't be hosting your information, or that can impair independence. But there's a lot of times where we'll go ahead and roll them for you way in advance of your year end, especially, maybe you have new debt, maybe you've bought property, you want to go ahead and send over those files as you have them handy. It's really easy to do those kinds of things, and makes it much simpler on the audit side. You get to year end and you already gave all the important information that is going to have a big impact. So it's a great way to be prepared. All right, well, we are now going to move into some common errors and findings. So these are things that I have seen on the audit side that you want to be mindful of and try to avoid when it comes to your financial statements and your audit that's being done. So a big one obviously is going to center around contributions. And that is just due to kind of the layers of complexity that can affect contributions. So a big error that can happen is that you can have improper revenue recognition under US GAAP because you may not properly be considering conditional versus unconditional contributions, or you could be not classifying those contributions correctly as with or without donor restrictions. Then obviously too, when you have donor contributions that have restrictions, you want to be tracking them and so that you can appropriately report when the release or when those restrictions have been met. Then also when it comes to in-kind contributions, those are things that have additional requirements. You may remember this has been a new standard in recent years. And so this is something where they put a lot of clarity into GAAP, into how in-kind contributions need to be recorded and presented within the financial statements. And then also when you're looking at contributions that have restrictions, you want to avoid using those funds before that restriction's been met. So really having a good tracking mechanism of contributions with restrictions in order to know that you're not dipping into funds that truly aren't available for general operations of the organization. So with that, I thought we could do a quick overview of different contribution types, just to make sure that it's clear how they should be recorded based on what they may have present from the contribution from the donor. Before I jump into these, though, just a good reminder that exchange transactions aren't following this guidance. Those are things where you're providing commensurate value for what you're receiving. Those are not considered contributions from donors and therefore aren't presented with those kinds of restrictions. These are really for any of the contributions being received from donors that are not where you're providing that value back in relation to what you're receiving. So it's really something being donated or given to the organization. When we look at contributions, the first thing you want to consider is whether or not something would be conditional. The reason this is the most important is that something being conditional versus unconditional is going to affect the timing of when you record that as a contribution. So when it's considered conditional, you're not going to recognize the contribution, but when it becomes unconditional, you will recognize it as a contribution. So a contribution is going to be considered conditional if you have both, this is an and statement, not an or, of the following items. One is that you're going to have one or more barriers that must be overcome in order to earn that contribution. And two, you want to have a right of return or some kind of right of release of the promisor. If both of those things are present, you do have a conditional contribution, and you can't recognize that as contribution revenue or support revenue until you've met those barriers and they've become overcome. If you receive cash in advance, so if it is funded to you, but you have barriers that have to be overcome and you have that right of return, that would be where you're going to see some kind of liability accrued rather than it being captured as contribution revenue. So it could be that you have the cash in your hand, but if it's got the barrier and it has that right of return, that still doesn't mean that it's truly contribution revenue yet to the organization. So important to be mindful of any contributions in so that you can be monitoring that. When we're going to look at indicators of barriers, there's a few different ways that barriers could be present for contributions. So one is that you could have a measurable performance related barrier. This is kind of the most obvious one that you're going to see. this is where there's going to be a requirement that you do specific things or have a certain number of outputs or some kind of outcome, something that is performance related that is specific as to what you need to obtain in order to earn the funds. So a good example of that is going to be, if you have to provide a certain number of meals to a certain population, or if you have to provide a certain amount of outputs, depending on what your organization does. So these are going to be very, specific items, and they usually have exact numbers or a level of service required. So usually easiest to identify. The next is going to look at discretion over the activity by the recipient. So by the group that's receiving the funds, how much discretion do they have over how you can conduct the activity that's planned? Limited discretion is going to be more specific than kind of the general activity being conducted or the general time frame. So it needs to be more than just, fulfilling the mission of your nonprofit. It needs to be specific as to these exact qualifying allowable expenses. It needs to be maybe specific to hiring specific individuals as part of the workforce, or if there's a certain protocol that has to be adhered to in order to expend the funds. So there's a few different ways, but the main thing here with the limited discretion is it's got to go a little bit beyond your normal activity or the planned, timeline that was already in place. Then also another indicator would be stipulations that are related to the purpose of the agreement. So that's going to be when it's going to be related to how you're going to handle the agreement. An example could be, that you're using it for some kind of subset. So maybe it's for a specific type of research report on a certain item. Maybe it's related to an expansion of a certain subset of the organization. So when it gets a little bit more specific, really what you want to be thinking about is those broad considerations of the organization. If it's in line with what you're already operating on, that may not be a barrier. It's when you get to more granular, more specific items that you're going to see those barriers come into play. And then if that's paired with that right of return or right of release of a promisor, that's where you're going to have that conditional contribution, and it should not be recorded on your financial statements or in your accounting system. Once something is considered unconditional, becomes a contribution, then you need to pause and look at, do you have restrictions that apply to that contribution? So that's going to affect not the timing of recognition, but really the classification of that contribution. So that's looking at your statement of changes in activities and net assets and the presentation of your net assets, and then also your footnote disclosures to ensure you're including them in the proper category. So that's when you're going to have stipulations around how that's going to be used that's more specific than the broad nature of the not-for-profit, or it could be looking at a specific time frame, things like that. These could be temporary or they could be perpetual. There's a lot of times when you get contributions to your endowment, you're going to be required to hold that corpus. And so that's something that would be perpetual or ongoing. So it's not affecting whether or not you're entitled to the funds. It's really affecting the presentation of them within your financial statements. When we look at in-kind donations, and like I mentioned, this was something that was clarified in GAAP a few years ago. I think it was 2007, don't quote me, but I think that was our standard that changed this one. It essentially said that you've got to present your in-kind donations separately from your other contributions. And then there's certain disclosures that you have to make when you have in-kind donations to the organization. So there's kind of two buckets things tend to fall into. You have gifts in kind, and then you also have the consideration of contributed services. Both are measured at their fair market value. Gifts in kind, you may be utilizing them at the nonprofit. So it could be land donated for you to build a facility on. It could be food donated that you're then distributing, or it could be things that you are converting to cash by selling. So it could be a home that was donated that you're selling, and you're going to now use that cash to further your mission. Either way, you've got to disclose what you're using those gifts in kind. So how are they valued, and then how are they being utilized? And then the way to kind of think about it is if you get the risk and reward of ownership of an asset, typically that's physical possession, but it could be something that's held or stored by a third party. But if you have that risk and reward, then that should be a gift in kind on your financial statements. When we look at contributed services, this is one that I can get questions on sometimes. Really, services should be recognized as an in-kind contribution if you have something that is created or enhanced by those services, or if those services require a special skill. So a good example here that I always like to use is that if a lawyer's volunteering at a food bank and distributing, meals, that's not the lawyer providing any kind of specialized skill or service for what they do. So that's not something that you would have to capitalize, however, or recognize. However, if that lawyer was providing legal services, could be at a discount or could be completely pro bono, then that is where you need to be recognizing those services. You've received value to the organization through those services that you would otherwise had to have gone out and paid for. So those things should get picked up and recognized. And that should be part of your disclosures as well, just to say how you're valuing those. I will say most times with all of these gifts, you should be able to go to that third party and be able to get their value. I know a lot of times that comes up as a question as well, because you're going to be, issuing those tax forms back to them for those donated gifts. You always want to be pushing for them to provide the value of what was provided to you, so that you have that. So I know, especially with services and things like that, lawyers will be able to kind of issue what would they have charged for those services in a normal scenario, and then that gives you kind of a basis to record that. So revenue recognition, how to make it easier. I'll let Jeanette kind of talk through this one.
Okay. You really need to have a process in place during the year. Just getting each grant, contract, or whatever agreement it is and looking at it and making a call at that time, if you get more than 1 or 2 a year, it is really essential. And the auditor is going to ask you, what is your evaluation process? When 606 came out, we were required to really document how we went through evaluating for all the things that Amelia just went through. It could be as basic as an Excel sheet that you set up, and here's the 7 things that we go through, yes or no, and at the end, if it's yes or no or whatever, this is how we record it, because it is complicated. You can have restricted revenue, now called with donor restrictions. It's, used to be permanently restricted. You can have ones on the balance sheet, blah, blah, blah. So you really need to have a process in place. And I go back to turnover or new people coming in. They need to understand how these evaluations were done. So you need to have it documented, and you really need to include it as part of your policies and procedures manual. And then, of course, refer to the procedures manual before you start evaluating. Sharing all agreements between development and programs. This is a misstep of a lot. When you are an organization that gets a significant amount of these types of agreements, again, whether it's grants, awards, however you want to call it, or just contracts, development is out there getting them. They are not well-versed in accounting, nor are they required to be, although they should have some education of how what they raise impacts what's going to hit the financial statements. So that involves education. But I would recommend meeting monthly between accounting and finance and development personnel. What do you have coming in? And this includes pledges too. What do you have coming in? Let's talk about, from accounting and finance, what that means for us, et cetera, et cetera. If this is a big part of your revenue, you should be having monthly meetings. Evaluating the proper recording at the time of the agreement. Development or whoever shouldn't run off, and get into an agreement that does not consult with accounting and finance, especially if it's out of the norm. Because if they sold and promised one thing, and then the impact on the financial statement is totally different, it's just going to create a downstream issue with folks trying to understand it, the board trying to understand it, et cetera, et cetera. Monthly reconciliation and meeting with other departments, I said, but again, if you have more than a one or two kinds of these agreements, you really need to make sure that you're recording in accordance with GAAP within your financial statements, hopefully within your system. And that includes allocating overhead, things of that nature, making sure it's in the right revenue bucket. Proposed recognition and gain approval from the auditors. I mentioned this a little bit earlier. We on the side for the outsourced services, we may, for some, but not for others, be involved in the grants on the front end. But I always encourage, send me the agreement. Let me look at it. We've seen so many agreements. I likely can look at it for 2 to 5 minutes and tell you what impact it's going to have. Do not wait until the end of the year. It doesn't need to cost you for me to do a bunch of research if you're bringing in the right people to ask if you don't have that in-house. And that goes to the last thing, consulting help. Listen, I always am a firm believer. We all have our lanes. I think there are incredibly smart people throughout the world, but nobody knows everything. So, we have nonprofit specialists. And you need to accept that not everybody knows everything, and align yourself with a couple of good consultants if you don't have it in-house that you can reach to and consult with from time to time, even if you're not, outsourcing.
Yeah, it's a great point. There's definitely times that I say, just send the agreement. It'll take me 2 seconds to take a look. So things that you may not spot easily on your side, auditors and consultants can usually know what we need to look for and find it quickly. So yeah.
And we have Amelia, looks like 7 minutes left. So
yeah, just a few minutes. I was going to say, this one really I've already hit on through the slides. Just looking at the proper presentation is kind of that common error that can happen. Looking at other finding and errors that can happen. These are kind of typical ones, I would say. We've done classes kind of on controls and things like that before as well. But obviously, having a lack of segregation of duties is always something to be on the lookout for. That's always going to be watched by the auditors. Who's preparing, who's approving, and those need to be kind of separate duties. And then just as a reminder for everybody, looking at controls, especially in electronic environment, the last 5 years, we've seen a really big switch over to more of an online bill pay system, online accounting system and everything. And so just making sure that when you're moving over to those, that you're putting the right controls in place and keeping them intact in those electronic environments. They all have a lot of built-in ability to do that. You just need to make sure you're utilizing them so you're not maybe negating past paper controls that you would have had. So we'll wrap it up now with a few of the challenges that maybe face for a successful audit.
And I think this is more not the challenges, this is the solution. So
the solutions, yes, your best practices.
Yeah, I titled that wrong. Okay, some of it I've already talked about. Bring in help. There's outsourced accounting. There used to not be such accounting outsourcing, and now it is pretty prominent. I'm going to guess that most folks don't love recruiting firms, but I will tell you that you align yourself with the right firm, and we have a big practice in that area as well. There are consultants that love just coming in and helping, whether it's technical, audit preparedness, what have you. You will just spend more time trying to find, didn't work out, trying to find again. And that takes away from mission and other things that you need to do. Find the right help or get recommendations. Planning meeting with the auditor. If your auditor has not reached out and set up a planning meeting, then you need to be proactive and do so. They should be doing that. Work backwards. You develop a calendar. Here's when the board is meeting. Here's when the audit committee is meeting. Here's when we need a draft because we need 3 weeks to review it, et cetera, going back to the start to make sure you have it all mapped out on a calendar. Request the PBC list way in advance. I don't know if the auditor is going to give it to you 6 months in advance, but you can pretty much know from the prior year PBC list, there is going to be a lot of similar things on there. So enough said on that. I've already talked about the accrual basis. Amelia and I are, CPAs, and we want, there is a reason that the accounting standards, give you a clean, unmodified opinion if you are fully compliant with GAAP. Again, that's not to say internal reporting needs are different, are going to be different. But I just think that's a good best practice, at least for your bigger accounts. Accounting, bill pay, and expense reporting systems. If you're not efficient and have to find and produce paper or electronic paper, it's time consuming. Auditors can get read-only access these days. We mentioned that. And that can really hold up. If you're having to reach out to 10 different departments for them to send you documentation that you then need to forward to the auditors, then you really need to look at the structure of how you're saving documents on your server. We covered the ask questions. You've hired the auditors. Ask questions so you can be knowledgeable. File structure we talked about. Client is required to prepare GAAP financial statements. You cannot rely on the auditor to do so. You're producing balance sheet, statement of activities, and maybe cash flow, maybe statement of functional expenses. But as we mentioned earlier, you're not doing all the footnotes, and you need all those footnotes in order to get a clean, unmodified opinion. Pull out last year's audit. Much of that is going to be on repeat. Make sure you have all that information. Reach out to your auditor or many others to say, what are our new standards? And as I know, I think I said on the next slide, or I'm going to say in the next slide, get training. There's lots of training like this, and it's free for 2 days. So you know what's coming down the pike. Make sure your folks are getting trained. Know that you're having a single audit under uniform guidance. We have a number of clients on our side that are getting their first federal awards. Do not wait to the audit to know what you have to do. It is very different. And you want to, the goal is not only everything we've already said, but no findings. A lot of this that we're going over today will make sure, well, nothing's a guarantee, but that you are doing the best that you can to limit any findings that you may get or eliminate them. And just be realistic. No one can do their regular job and squeeze in audit prep. You really, really need to be organized in this fashion. I've already kind of went over this, some complex things that we have noted, I would say, in our client base. The most difficult are listed there: rev rec, leases, overhead allocation, also another complicated thing it can be, and a lot of organizations don't do that during the year. We had great information from Amelia on internal use software. And then, as I said, preparation of the statement and footnotes. All right, some other suggestions here. And I see there's a question, do we offer training on footnotes? And I would say reach out to Amelia and I after. We certainly do a lot of trainings, and we can get you to the right place.
Training on footnotes. I'll teach financial statements any day.
Yeah, and we come in individually to clients to help them, and not just on a seminar like this. Next slide.
Yep. All right, we'll go
Last
into our
one.
question.
Go ahead, Amelia.
Oh, you're good. Yeah. So what can you do to set up your organization for a timely audit completion? So you provide the auditor the requested information when they ask, divide up the audit list and to your staff and give them due dates, monthly reconciliations on the accrual basis for all your balance sheet accounts. Be nice to the auditor. Whew, love that one. And all of the above. I always tell people, you gotta love your auditors, because then when you want to like throw us under the bus for everybody else, right? Then I'm happy to. I love being thrown under the bus to make somebody be more audit ready for you.
And while we're waiting on this, after this is done, and I see John is coming in to wrap it up, our contact information, I think, is going to be on the last slide. So you'll see that as well. And please reach out. We would love to be able to help.
And Eunice, if we can close that poll, we'll knock out that last one really quickly. Perfect. So the last one obviously being, would you like for a member of our team to reach out to you? So thanks everybody. And John, we'll turn over to you.
Yes, Jeanette and Amelia, thanks so much for the great presentation. Of course, being on the audit side, loved all the tidbits from both sides, great insights. And yes, trust us, as you're as an auditor, we want to make life as easy as possible for you. So, and the key to that is communication throughout the year. There's no doubt about it. And a lot of good tips. So this concludes the second session of the day. Again, if you have any follow-up questions, don't hesitate to follow up with Jeanette or Amelia. Their contact information will be in the slide. We're going to now have a 1-hour break for lunch. The next session is going to be securing the mission, cyber risk and IT assessment strategies for nonprofit resilience. That'll start 1:30 sharp Eastern time, 12:30 Central, and then an hour, whatever time zone you may be in after that, different less. If you haven't registered for the next session, just look at the link, find the link in the chat if you haven't registered again. And before you leave, please give us your feedback on things you would like us to see do a little more of, things you appreciated during the presentation. Session recordings and presentations will be available in about a week, so you will definitely be able to get access to these. And again, thanks so much for joining us for this session, and hope you can join us for the last 2 sessions this afternoon.
Thanks, everyone.